Hey everyone, welcome back to Corporate Decoder. Today PVM has filed an 8K reporting a material definitive agreement, and it looks like they just secured some new financing that comes with some interesting strings attached. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details a new loan and a significant equity option that could drastically change the company's ownership structure. Alright, let's dive into what Phoenix Motor Incorporated, or PEVM as you probably know it, has just disclosed. This is a Form 8K, which generally means something important has happened that the company needs to tell investors about right away. The main event here is a new loan agreement. On the 1st of June 2026, Phoenix Motor Inc. entered into a term loan security and guarantee agreement with Concrete Jungle Limited. Essentially, the company got a loan, but it is not a simple one. They received a term loan facility of $4 million. But here is where it gets a bit unusual. This loan is backed by a senior secured term loan discount note with a face value of $5 million. This note matures in about a year, in May of 2027. It carries a base interest rate of 10%, which can go up if the company defaults on any of its promises. The difference between the $4 million loan and the $5 million note is $1 million, which is called original issue discount. This is a common way lenders get a higher effective yield on a loan. The company can pay back the loan early, but there might be fees or penalties involved. Now, like most loans, this agreement comes with rules or covenants. These are pretty standard. The company has to keep sending information to the lender, stay in business legally, maintain insurance, and importantly, they can't just take on tons of new debt or sell off major assets without permission. They also have to get a valuation report on their subsidiaries, and then there are the things that would trigger a default. These are also pretty typical if they don't pay back the loan, break any of the rules we just talked about, get into major legal trouble, or if there is a significant change in who controls the company. This is a really important part. To back this loan, Phoenix Motor Inc. has pledged pretty much all of its assets and the assets of its related companies as collateral. This means if the company can't pay back the loan, the lender can come after everything. This is where it gets interesting. The lender, Concrete Jungle Limited, gets to appoint people to the board of directors of Phoenix Youth Inc., which is a subsidiary. They also have control over changes to those board members. This gives the lender a significant say in how the company is run. But that is not all. Along with the loan, the company also issued a warrant to the lender. This warrant gives Concrete Jungle Limited the right to buy about 80,896 shares of Phoenix Motor Inc. It's common stock at $3 per SHF. This warrant is good for 5 years. If the stock price goes above $3, the lender can buy these shares, which would give them more ownership and potentially profits if they can sell them for more than $3. This is a form of equity kicker that often comes with loans to riskier companies, and to make sure the lender can actually sell those shares if they choose to. The company also signed a registration rights agreement. This means Phoenix Motor Inc. will file paperwork with the SEC so that the lender can legally sell these shares to the public. This process makes it easier for the lender to cash out their investment. Now, this is where things get really interesting, and frankly, a bit concerning from a shareholder perspective. The company entered into an option agreement that gives the lender an exclusive right to buy a very large chunk of a subsidiary. The company granted Concrete Jungle Limited an option to buy 49% of the equity interests in Phoenix. This is a huge portion, and it is calculated on a fully diluted basis, meaning it includes all potential shares. And here is the kicker. The price to exercise this option is $2.25 million, but they don't actually have to pay cash. Instead, they can use that money to reduce the amount they owe on the $5 million note down to $2.5 million. This is a clever way to fund the acquisition with borrowed money. To secure this option and the main loan, the company also pledged equity interests in other subsidiaries, so more assets are on the line. There was also an amendment to an asset purchase agreement. This likely relates to how certain liabilities and responsibilities are handled from a previous deal, possibly tied to the Phoenix EV subsidiary. The money from this new $4 million loan is mostly going towards paying off old debts to a company called J.J. Astor & Company, and then covering the costs of this new deal. Speaking of J.J. Astor & Company, the company also reported a termination of a material definitive agreement. It looks like Phoenix Motor Inc. has settled a dispute and paid off its obligations to J.J. Astor & Company. This happened on the 1st of June, right around the time of the new loan. They entered into a settlement agreement back in May. To clear this debt, Phoenix Motor Inc. paid $3.8 million in cash and also transferred 4 electric buses to J.J. Astor & Company. The buses were valued at $870,000 and applied towards the debt. However, the company also has to buy back those 4 buses within 90 days for the same price plus costs. If they don't, JJ Astor and Company can sell them, and there are provisions for any difference in sale price. This sounds like a temporary transfer of assets to satisfy a debt. So essentially, with this new loan, they paid off an old debt. All the liens and security interests tied to that old debt were released. This section just confirms that the new loan is a direct financial obligation for the company, which we already covered in item 1.01. This item details the issuance of equity securities that were not registered with the SEC. As we discussed, the warrant for the lender to buy shares at $3 is part of this deal. These warrants and the shares they represent were issued under an exemption from registration. This typically means the lender is considered a sophisticated investor who doesn't need the full protection of a registered offering. And finally, the company lists all the documents that are attached to this filing as exhibits. This includes the loan agreements, the warrants, and the settlement documents. The filing is signed by Xiaofeng Denton-Peng, the Chief Executive Officer, on the 5th of June 2026. This filing shows Phoenix Motor Inc. is actively seeking financing, but it comes at a cost. They've taken on a new loan that is heavily secured by their assets. And the lender has significant influence over a key subsidiary. The potential for dilution from the warrant is also a concern for existing shareholders. On top of that, they've cleared a past debt by paying cash and transferring assets that they then have to buy back within 90 days. It is a complex financial maneuver. What I am watching here is how effectively the company can grow and generate enough cash flow to service this new debt and to repurchase those buses, all while operating under the watchful eye of their new lender who has a direct line to the board of Phoenix EV Inc. The 49% equity option on Phoenix EV is a major red flag for future ownership dilution if exercised. The research tools I use to break down these filings are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found value, smash that like button, subscribe for more, and join the Discord linked below.